I started my investment journey more than a decade ago, and I know it can feel intimidating, especially when you're just starting out. But today, I'm gonna break it down to a 5-step process on how you can start your investment journey with as little as just $100. But before that, I have to share my story on why I started with the stock market instead of the more popular one, which is the real estate, right? Well, I knew that saving alone will not grow my wealth. And for the sneaky inflation, I had to invest it somewhere. But back then, for a 20-something-year-old, real estate was really hard to get into. And honestly, quite capital heavy. And I was skeptical about putting all my life savings into just one investment. And after months of research, I finally had to pull the trigger. And since then, I'm a long-term investor in the stock market. And let me tell you, investing in the stock market these days is so easy that if you're not doing it, you are actually missing out on a big opportunity. All you need is some cash and a smartphone. And trust me, with enough time and consistency, your $100 investment will turn into $1 million. And yes, in this video, I'll show you how to pick a stock brokerage and how you can actually buy a stock from that stock brokerage. So make sure you watch till the end because this video is gonna be packed full of information. So step number 1 is understanding the basics of stock market investing. There's so much information out there that you feel overwhelmed and you end up doing nothing. But the basics are pretty simple. As a beginner, you only need to know the following things. Let's start with what is a stock market. In very simple words, stock market is a place where you buy and sell shares of companies. When you buy a share, you own a piece of that business. Let's take an example. Think of a large pizza as a company. Each slice of pizza represents one share of the company. If there are 10 slices in the pizza, each slice represents 10% of the company. Now, if you buy 2 slices, you own 20% of the company. If the demand for this pizza goes up, maybe it's a famous recipe or a limited edition, the value of each slice increases, making your 2 slices even more valuable. Now, how do stocks make money? There are essentially 2 ways that you can make money through stocks. One is the capital appreciation when the value of the stock goes up, and then you sell at a profit. Let's say if you buy 10 shares of a company at $100 each, that is worth $1,000 in total. And later, if the price increases to $150 per share, your investment is now $1,500, giving you a $500 profit if you sell. I'll discuss the tax implications later in the video. And the second way you can make money is through dividends. Dividends are like a reward that some companies give to their shareholders just for owning their stocks. When you own a stock, some companies share a portion of their profit with you. These payments are called dividends. You can either receive these dividends as cash or you can reinvest them to buy more shares called the dividend reinvestment plan or the DRP plan, helping your investment grow even faster over time. Well, not all companies pay you dividend, but those that do often provide a steady stream of income. Is the stock market risky? Of course, every investment comes with a risk, and stock market is not any different. So yes, the stock market is risky, especially in the short term. There are many factors that influences the fluctuation of a share price of a company, but you can reduce it by researching about the company, reading about those financials, checking the balance sheet. You can do all the research, but there are certain things that you cannot control, that are beyond your control, like the market sentiments or even the economic conditions, the government policies, global events, natural disaster. There are many other external factors that influences the market, and you can't do much about it. That's why it's highly recommended that you diversify your portfolio by investing in multiple industry or multiple stocks and not by just investing in one company. And how do you diversify? You invest in ETFs or index funds. An ETF is a collection of many companies bundled into a single stock, which you can buy like any other stock on the exchange. As beginners, you should start with an ETF that tracks a major index. There are major indexes across the globe, like the S&P 500, which tracks 500 of the biggest American companies. Then comes the ASX 200, tracking 200 top Aussie companies. We also have other indexes to choose from, like the CSI 300, which tracks 300 biggest Chinese companies the FTSE 100 tracking 100 biggest UK companies, the Stocks 600 tracking 600 biggest European companies, the TSX 60, that's 60 biggest Canadian companies, and then there's Nifty 50 tracking 50 biggest Indian companies. I'll put a link in the description for all the indexes so that you can do your research and what are the companies in those indexes, but it's always a good idea to start with index funds. The overall stock market has averaged between 8 to 10% return every year for the last 100 years. So instead of trying to beat the market by picking individual stocks, you can just simply invest in the entire market and get the average returns. So why should you invest? The simple reason is because of inflation. Inflation is the rate at which the general cost of goods and services increases over time. Have you noticed how much more expensive groceries are today compared to 10 years ago? It's inflation doing its thing. If you put all your money in the bank, it'll slowly lose its value over time. So the easiest way to combat inflation is by investing it, allowing it to grow over time and not only keep up with inflation, but also increase your purchasing power in the future. The stock market in the short term is very unpredictable, but in the long term, it does well. Historical data shows that the Australian and the US stock market have consistently gone up in the long term. According to the 2024 Vanguard Index chart, the Australian stock market has averaged a 9.1 annual return over the last 30 years, and the US market averaged 11.1 per year over the same period of time. While the future performance is not guaranteed, but the historical results does give a level of assurance. So what's the difference between a share and a stock? It's a very common question. A share refers to the individual units of ownership in a specific company. For example, you would say I have 100 shares of Apple, whereas stocks are a broader term that represents ownership of one or more companies. For example, if you own multiple stocks, it could mean you have ownership in multiple companies, like 100 shares of Apple, 200 shares of Tesla, 150 shares of Commonwealth Bank, etc. All right, Step 2 is setting your financial goals and strategies. Firstly, you need a financial goal. You need to ask yourself, why are you investing? Do you want to achieve F.I.R.E, that is financial independence, retire early? Is it for long-term wealth building, or is it only you want to make few short-term wins? So once you have decided on your financial goal, determine how much you can afford to invest consistently every month. To determine the amount, I highly recommend you start tracking your income and expenses. Do a monthly budgeting. Make sure you know what is coming in, what is going out, what's the extra that you can afford to invest every single month. Now, if you don't know how to track your expenses, I do have my own Google Sheet that I personally use. I'll put the link in the description, and I have also a dedicated video. I'll put the link for that video as well. You can check that out. But this is very important to track your income and expenses so that you can consistently invest for the long term. Now, once you have determined how much you can invest, you have to come up with an investment strategy. Will you start with the much less riskier ETF or single stocks? As a beginner, I highly recommend you start with an ETF, that's exchange traded fund. If you choose to invest in ETFs, you need to think long term. We're talking 10, 20, even 30 years. This gives your money enough time to ride out the stock market's ups and downs. Remember, investing can be emotionally draining since you'll see your share price going up and down every day. Without the right strategy, you might panic when you see your shares going red and can be tempted to sell everything. That's not smart investing. So instead, you can choose to dollar cost average. Dollar cost averaging is basically investing a fixed amount regularly, regardless of the share price. There's a popular saying in the investment world that time in the market beats timing the market. The dollar cost averaging strategy removes the emotions from investing by eliminating the need to time the market. For example, you can choose to invest $100 on the first of every month into your chosen ETF, regardless of the share price at the time. So if your ETF is $10 per share, you buy. If it's at $8, you buy. And if it's $15, even then you buy. You're not trying to beat the market. You're just aiming to get the market's average returns. And as we saw earlier, historically, both American and the Australian market has returned between 8 to 11% on average annually over the long term. To demonstrate this, let's look at the compound interest calculator. If you make an initial investment of $100 today and continue investing $100 every month for the next, let's say 45 years, assuming the annual average return of 10%, your portfolio will grow over $1 million. And here's what's fascinating. Only $54,000 out of that $1 million was your contribution. The rest is the returns from the stock market. Of course, this is a very simplified example and doesn't show you the real data. But if you want to check the real data, I have a dedicated video on how the compounding works. I'll put the link in the description where I've used the last 30 years of S&P 500's real data and analyzed them. So you can check that video as well. I'll put the link somewhere in the description. All right, number 3 is choosing a reliable online broker. An online broker is a platform where you buy and sell shares. This part of the video is specifically for Australian audiences, so if you're not based in Australia, you can safely skip this part of the video and move on to the next chapter. So since we're in Australia, you have to sign up to an Australian online broker to buy and sell shares on the ASX. In Australia, we do have a good selection of online brokers to choose from. I would highly encourage you to do your own research when selecting your online broker. A good place to start your research would be comparing sites like finder.com.au or cancer.com.au. You have to look into few things when choosing an online broker. The first thing is the fees. Because every time you make a trade, whether you buy or sell, you have to pay a brokerage fee. So choose something that you're willing to pay every time you make a trade. Next is whether your brokerage offers you CHESS sponsorship. Not all broker offers you CHESS sponsorship. Now, when it's CHESS sponsored, meaning your shares are registered directly on your name on the ASX. This provides a better security if your broker goes out of business in the future. Whereas non-CHESS sponsored brokers follows a custodial model, meaning they will hold your shares on your behalf. So if in the future they go out of business, it might get a bit messier. So choosing a CHESS sponsored broker is very, very important. And the third is the ease of use and good research tool. You want a simple user interface platform that will help you in your investment journey and allow you to help doing your research. All right, step 4 is actually buying your stock. Regardless of which broker you decide to use, I'll show you a quick example on how you can actually buy a stock using an online broker. All right, I'm in my screen now, so I'll show you exactly how you buy stock. So this you can think about like any online broker would look like this. The UI might be a bit different, but the functionality would be exactly the same. So what I'll do is I'll go to trade. So trade is where you buy and sell shares, right? So we'll go to buy. All right, so once I'm in trade, I can buy or sell, and this is the available fund, which is not much at the moment, but I'll go and show you how you can buy a share. So let's say I want to buy Asia ETF, for example. By the way, it's not a financial advice. I'm just giving you an example, right? So you buy, let's say just one. Yeah. When you're buying, you can buy like under 3 conditions. One is limit price, one is at market, and one is conditional order. So the limit price is basically you set a limit. So let's say you want this order to trigger at a certain price. So let's say right now it's going on $10.53, but you don't want to pay that price. You want to pay, let's say, $10.40. Right? You put 10.4 and then you place the order, right? In that way, when the stock price will hit $10.40, then this trade will execute, right? And then there's this market. So basically, once you select market and you place order, it will instantly execute your trade, meaning you are happy to buy whatever that stock price is currently in the market. And the next one is the conditional order. So there are certain conditions. So trigger if the price is below or above a certain price, and then you buy, let's say, 20 units of those. So those sort of conditions you can apply to your trade. And you will see, let's say I will put at market. And now if I put, let's say, 2 quantities, then you see there's no brokerage at the moment because my brokerage allows me to buy trades without brokerage fee up until $1,000. But beyond $1,000, it charges $11 per trade. So that's fairly simple. This is how you actually buy and sell shares. So for selling, it will be like you go to sell, similar, you go to the trade section and then you sell it. So whatever amount you want to, or if you want to sell a certain value. So if you have like 10,000 worth, you sell 5,000, or quantity wise, let's say you want to sell 30 quantities, for example. And then if I sell 30 quantities, I will get a return of $303. And there's a brokerage fee of $11. And then you place the order, and there should be a trading pin for your security so that the online brokerage would make sure that you're the owner of this account who's executing the trade. So that's pretty much it for the buying and selling shares from any online broker. So I hope this was helpful, and yeah, let's go back to the video. All right, step 5 is understanding taxes. Now, based on where you are, you have to comply with the taxation system of that country. So I'll talk about the Australian taxation system regarding stock investing, but if you are not based in Australia, you can skip this. So in Australia, we have 2 main types of tax that you need to be aware of when investing in stocks. Number 1 is the capital gain tax. This is the tax you pay on your profits from selling shares. For example, if you bought 10 shares of Apple for $100 per share and sold them all at $150 each within first 12 months, you'll pay capital gain tax on your $500 profit. This $500 will be added to your total taxable income, which includes your salary, bank interest you might receive, and other income sources. You will be taxed at your current tax rates, which ranges between 16 to 45%. Now, if you hold your shares for 12 months or more, you'll get a capital gain discount of 50% on your total profit. So in this example, since your profit is $500, with the 50% discount, you'd pay taxes on $250. Now, it's not always that you'll make profits. You will also make losses, right? So let's say for the same example, you sell all your Apple shares at $50 and make a $500 loss. You can offset this loss against your current capital gains. For example, you make $500 profit by selling stock A, but make $400 loss by selling stock B. You'll pay tax on the $100 difference. Please note, you can't use capital losses to reduce your normal taxable income. These losses can only offset current or future capital gains. If you don't have any capital gains in the current year, you can carry the losses forward. This is known as carry forward losses. Alright, the second type of tax you pay is on dividends. Now, I love dividends. It's like cold hard cash coming right into your bank account without much work. This is the ultimate passive income, but unfortunately, you still will be taxed. So if your shares paid you, let's say $500 of dividend for the year, you must declare it. Even if you use a dividend reinvestment plan to automatically reinvest your dividends, you'll still need to pay taxes on them. Your total dividend received will be added to your taxable income and taxed at your current rate. Well, it's been a long video, but if I have to summarize the whole thing, it comes down to this. Investing in the stock market can feel intimidating at the start, but if you have the right strategy in place, you don't need to overcomplicate things to be successful. Personally, I prefer to the dollar cost averaging method into my index funds and ETFs. This method removes the emotional aspect of investing and allows you to build wealth steadily over time without getting caught up in the timing the market or complex trading strategies. And remember, there's no minimum amount to get started on your investment journey. The most important thing is to start. Just start. And I hope this video will help you to give you the confidence to take that first step. And please do give it a thumbs up and share with someone you really care about. Your support means a lot to me. Thanks for watching. I'll see you in the next one.